Joe wants to start investing, but has no idea where to start. He has, however, heard of unit trusts, but he knows very little about them. Let's see if we can help Joe out. The first thing Joe needs to understand about unit trusts is their structure. Unit trusts are pooled resources of thousands of investors who have entrusted their money to a management company. The investors can make investments from as little as a 500 Rand monthly debit order to a lump sum investment of 20,000 Rand. You can also see how the structure works if you look at a statement. The unit price published daily by the asset manager is the value of 1 unit of that unit trust after the asset management fee. Then times the unit price by the number of units. Now you have the investment value. If the unit price moves up, the value of the investment moves up. Conversely, if the unit price moves down, then the value of the investment moves down. It is the asset manager's job to try and maximize the unit price of their unit trust within their mandate. As you can see, the asset manager has a very important role to play. Each unit trust fund will have to operate within its mandate. A fund's mandate tells the asset manager how to manage and operate his fund. For example, a unit trust with an equity mandate will only be allowed to purchase equity stocks on the JSE. The mandate can even be more specific, stating that the stocks that can be purchased must be in the JSE Top 40. Asset managers have to analyze the economy, the industry, international and political risk, and all other factors that could affect investments within the unit trust. You pay them to make sure they get you the best return possible using all the resources at their disposal. Another important aspect of deciding which unit trust to invest in is the asset allocation. Asset allocation is the distribution of investments within the fund between the different asset classes, such as cash, equity and bonds. This is important because over the long term, asset classes normally follow the principle illustrated in this graph. You can see that on the graph, cash has quite a low risk rating, but it also has a low expected return. On the flip side, equity has a much greater expected return, but has a higher rating of risk attached to it. There are no free lunches in investments. If you want a higher return for your investment, you have to accept a high degree of risk. Looking at the asset allocation of your unit trust can tell you a lot about the unit trust's expected return and risk rating. Let's go back to Joe and see how he is doing. He now has some idea of what a unit trust is, how it operates, and in what it invests. But with a unit trust investment universe over 967 funds, how does he choose which unit trust to invest in? This is where a financial advisor can help Joe. A financial advisor can analyze Joe's investment goals. From there, choose which unit trusts are right for those investment goals. And finally, continually monitor and review those investments with Joe on a regular basis. There's a lot more to unit trusts and investments that we haven't covered here, but you should have the basics down. In future videos, we'll take the opportunity to dive deeper into those aspects. So what's the first thing that Joe can do? He can take up a debit order as low as 500 Rand per month. It's an important step, both practically and psychologically. The sooner he starts, the better.